Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, October 23rd. You're tuned in to On Trend, the show designed to keep you on the right side of the trend. Today, we'll look at the major indexes to show you the NASDAQ 100 is the last index standing. We'll look at new highs in the sectors. We'll look at banking ETFs that are breaking down further. Staples, utilities, and healthcare are holding up for now. Gold versus the dollar and utilities versus the 10-year. And finally, we'll do a walk around the world and look at some global equity indexes. The NASDAQ 100 is the last index standing. So before we look at the charts for the major stock indexes, I just want to show you the high-low lines for three broad market indexes, and they do not look good. Now, the high-low line is basically a cumulative measure of high-low percent. So high-low percent is positive when new highs are outpacing new lows, and high-low percent is negative when there are more new lows than new highs. So this line will typically rise as long as new highs outpace new lows. And you can see that this line rose from March 2018 for small caps, since April for mid caps, and since May for large caps. And you just need a 10-day EMA because it's a very smooth line. And so it was rising, and it rose for 110 days, basically, from early May to early October. And then on October 11th, the line crossed down below its 10-day EMA for the S&P 500. And then you can see a little earlier, we had a cross in the mid-cap high-low line, and then a cross in the small-cap high-low line. So, these can whipsaw just like any other indicator, but the fact that they have turned down tells you the environment, the broad market environment has changed. At the very least, there's a lot more risk out there because there are a lot more new lows. New lows are outpacing new highs. And at the very most, we're in for some sort of a bear market. So I go to Fuller Tracy Money periodically because Owen Tracy writes some good stuff, and he also provides some good insight into other articles. And he provided a cutout from a piece by Howard Marks of Oak Tree Capital. And Howard Marks always has really good insights. And he was writing the words you should never say here. And I'd recommend you go and you read that. And I'll highlight some of the points here is that, everybody wants to know how long an upswing lasts. Well, the first thing you need to do is dispense with any concept of regularity when you're dealing with the markets. All right. That's because in truth, the market cycles vary from one to the next in terms of their amplitude, speed, violence, and duration. It's all different. All right, so nobody really knows how long a market cycle will extend. All right, and that brings up the whole concept of predictions. All right, it's really hard, almost impossible to predict. And so the next concept is, okay, well, just tell me, when will the market turn down? And he says, I never answer a question that starts with the word when. In the investment business, sometimes we know what's going to happen, but we never know when. So I would dispense with that immediately. All right, it's highly ambiguous, and what we need to do is wait for the markets to tell us things have changed and then act accordingly. So Owen Tracy then provides his view on the subject, and he has a great line here. We need to foster the humility to allow the price action to unfold as it will and tailor our tactics accordingly. In other words, we act when price tells us to act. And to do other than react to reality is to engage in fantasy. And then he goes down and he explains his different tactics for identifying trends and trend changes. Consumer discretionary sector leads the new low list. So this next chart shows the high-low percent indicators for 9 sector SPDRs. We don't have that broken out into XLC and XLRE yet, But, this gives you a pretty good idea of what's happening in the market. We look at the S&P 500 there at the top, and we can see that high-low percent dipped below 10% there about a week and a half ago, and it's at minus 7.2% now. So you can see new lows are outpacing new highs. And the only place we're getting new highs are three places, really. The only places are utilities, healthcare, and some consumer staples. And I've got some green arrows here, and that's when these indicators moved above plus 10%. So utilities have been on a bullish signal since the latter part of June here. Healthcare has been on a bullish signal for over a year. All right. You had some, lackadaisical performance here in February, March, April, May, but high-low percent did not get below minus 10%, which is my bearish threshold. And then it started expanding again in June. So healthcare has been bullish for over a year. And consumer staples turned bullish in June with that move above plus 10%. And they will remain bullish until we get a move below minus 10%. But that basically means 3 of the 9 sectors are net bullish for this indicator. That means 6 of the 9 are net bearish. That is well more than, that's probably 70+% of the market right now. So that is much more of the market is bearish. And if we scroll down, I've got it sorted, okay, from the least negative, which is technology at minus 4.55%, to the most negative, which is materials, minus 46%, basically. And we can also see the bearish signals that have been triggering. On October 10th, the XLK high-low percent moved below minus 10%. So that is showing you there are enough new lows to turn bearish on this sector, and most of them are coming from the semiconductor group. Now, energy turned bullish in April. Even though we had some new lows expand yesterday, we haven't gotten below that minus 10% threshold. So technically, it's still on a bullish signal. Industrials turned net bearish on October 10th, just like utilities. So that was a pretty big day, October 10th. And you can see October 11th, the finance sector turned net bearish when you had an expansion of new lows. Consumer discretionary was first on October 5th. And then look at all these new lows. All right. And the reason I'm putting this one as the leader is because there are a lot more stocks in the consumer discretionary sector than in the materials sector. So there are around 67 stocks in the consumer discretionary, and you have 18.5% hitting new lows. That's around 12 to 13 stocks in this sector. And then you have 26 stocks in the materials sector, and you have 46% hitting new lows, and that's around 12 stocks. So the consumer discretionary sector is a bigger sector, and clearly it's much more dependent on the U.S. economy. And the fact that it is leading in the new low category is big cause for concern for the broader market, because most of these companies are U.S. centric, and that tells you there's an issue in the U.S. All right, I'm usually not that concerned with what's going on outside of the U.S. because the U.S. will turn when it turns. All right, sometimes the U.S. bucks the rest of the world, as it did for quite a few months. But now the U.S. is looking like it has turned. We can further augment the bearish case when we look at the equal weight S&P 500 ETF and then the equal weight sectors. And these equal weight sectors, as their name implies, they weight the stocks in that sector relatively equally. All right, so the technology SPDR XLK is going to weight the large caps heavier than the small caps and mid caps, whereas this equal weight technology sector ETF is going to treat everybody the same. So it gives you an idea of what's happening to the average stock within that sector. So first and foremost, we can see that the equal weight S&P 500 has been below its 200-day moving average for 3 days now. It'll probably be 4 with today. And it didn't close below the 200-day moving average in February, March, April, and May. So this is something different. This is a change. Technology as well held above that 200-day, but the equal weight technology is below. Equal weight consumer discretionary is below. In fact, look at that. That's a new low for 2018 for the equal weight consumer discretionary sector ETF. And that is one of my biggest concerns with the market when you see that kind of weakness in such an important sector like consumer discretionary. Industrials, equal weight industrials below the 200-day, equal weight finance. That is a new low for 2018 on a closing basis. And it could hit a new low this week or within a couple of weeks if it breaks below that November low. But this is one of the weakest sectors because there you can see a lower high and then a breakdown. And then we get into one sector that's holding above the 200-day, and that would be the equal weight healthcare ETF. But again, you know, if we're in a bear market environment or a higher risk environment, even picking winners in healthcare is still going to be a challenge. Right now, it's still holding up. Then we look at energy. Well, equal weight energy is broken below the 200-day. Equal weight materials, the weakest sector because it hit a 52-week low this week. And then the other two pockets of strength would be consumer staples. But as I'm going to show on a chart in a minute here, I am not bullish on this sector. Utilities I'm still bullish on because they continue to rise here and are well above the 200-day. So really the only sectors I can think positive about would be healthcare and utilities. So I'm going to look at three individual sector charts here. First up is industrials. And you have to ask yourself, is this normal, this kind of a decline? And I would just say it's not. It is not normal for a correction within a bull market. I know they always say that, you know, pullbacks are always sharper than advances. Well, there's something in this pullback that just doesn't look right. And if you look at the prior decline we had that was similar in January, February, you know, it took several months to stabilize after that decline. And you tested this low area 4 times before you finally made an advance. And now we've given it almost all back. So this is not normal. And when things are not normal, you have to make an adjustment. And usually that adjustment is raising cash, because there are a number of ways to reduce your risk. And one is to move into cash. Cash really is a position. If we look at consumer staples, here is the reason that I am not positive on consumer staples. This is the unadjusted consumer staples SPDR, and we can see the big decline, and then the bounce retraced around 61.8%, around 2/3 if you will, and broke down here. Now we did have a bounce back, and that was led by that big surge in Procter & Gamble on Friday. But I think this break is in, okay? The break happened. Sure, we've had this bounce back, but I look at the broader market environment and I look at this chart here, and I would not be positive on this chart. I would be more inclined to be bearish, you know, maybe less bearish because it is a consumer staple and a defensive group. And finally, utilities. Now, the reason I'm still bullish on utilities is because you can see that we held the support zone from the summer lows and we got this surge. And so there is an uptrend here, pullback, breakout, consolidation, breakout, deep pullback, but a bounce back. But again, you know, we're in a bear market environment and we're still fighting against a bigger tide that is pushing the market lower. Finance and banking ETFs break down further. So I highlighted the new lows in the consumer discretionary sector. That is a big negative for the market. Here is the second big negative. It would be the finance sector is one of the weakest sectors out there right now. So, you know, XLF had its chance. You know, it had this nice advance from 2016 with some small consolidations along the way, and then a 52-week high in January. And then I viewed this as a correction. And we started to break out here, but this breakout failed miserably with a sharp decline 3 weeks ago. And that was a breakdown. And once we had that breakdown, we had to reassess what was happening. We had new information coming to us, a new reality, and we have to make an adjustment. And so now we have a lower high. You know, anything that did not make a new high or exceed its January high in the summer or the early fall is underperforming. And finance was underperforming. I think it was the only sector that didn't make it above its March high. So we have this breakdown now. And, the next stop might be around 24.5, 25. But, as far as downside targets, take them with a bucket of salt, if you will, because the trend is what matters the most here. And the trend is down, and it'll stop when it stops, okay? When you just need to evaluate price action on a daily, weekly basis. And then when we see something that is bullish, we will react. But until then, this one is to be avoided. We look at the bank ETF. It looks even weaker. You had this triangle consolidation, but what was negative about the triangle was you had a lower high and a lower high. And this is when the market was moving higher. So, the banking ETF was already underperforming, and then there's the breakdown, the straw that broke the bull's back. So banks are not looking good at all, and the next support might be around 40. And you can see at the bottom, I got the PPO 5260. It turns negative when the 5-week EMA moves below the 26-week EMA. And, it'll have whipsaws like it did here in the August-September period of 2017. But for the most part, it'll get you on the right side of the trend. Broker dealers, similar situation. All right, so all of these were acting the same. They had these lower highs coming in when the market was making higher highs. And now they've broken down, and so we target our next support levels. And it is a guesstimate. It's not a hard support level, if you will. And then regional banks. And there's a key word here in this ETF. It's called regional. And what does that tell you, regional? Well, it tells you that it's mostly domestic. All right. They were reflecting what's happening in the U.S. All right. Sure, some of the big banks maybe have exposure overseas, blah, blah. But regional banks are about the U.S. And you see what's happening to housing. That's not a good sign. You got the breakdown here. We had another breakdown 3 weeks ago. And yeah, I'll mark next support, but, we could easily break below it. We're getting oversold, but, you expect oversold conditions when the bigger trend is down. So banks are not looking very hot at all. There's some strange goings on when we look at gold and the dollar and utilities and the 10-year. So I noticed that gold was doing pretty well, and so was the dollar. And that's usually not the case. Usually there is an inverse correlation between gold and the dollar, and that means they typically move in opposite directions. So if the dollar is strong going up, you would expect gold to go down. So I went back and I looked at the correlation coefficient over the last 6 years here on this chart. So the top window, I've got gold. Here I've got gold and the dollar with a 13-week correlation coefficient. And I've got a line at 0.25 that shows you when that correlation got modestly positive here with the red lines. And then I've got the S&P 500 for reference, and I've got the dollar for reference. And I was seeing if there was any kind of pattern that I could make out here. Because you can see, in the beginning of 2013, we had a positive correlation between gold and the dollar. But we can see the stock market moved up. Same thing there in the latter part of 2014. And here we got one in 2015, and the market went flat. All right. The dollar also peaked soon afterwards. And if you look here, you can see we had another one in July 2016. The stock market was down for a few months and then turned up. And we had another one in July 2017. Stock market was weak for a month or so and then moved to a new high. And we have one now. I don't see any real rhyme to this on what the cause and effect is. But what it does tell me when gold and the dollar are going up together is something is out of sync in the financial markets. And that could add to this risk-on environment that we're currently in. And gold could benefit along with the dollar. Now we look at utilities in the 10-year Treasury yield. Usually these two are negatively correlated. Usually when the 10-year Treasury yield rises, utilities tend to underperform because utilities are basically the bond proxies. And so if Treasury yields are getting higher, that's more competition for utilities. But here we can see that, the Treasury yield has been rising here, and utilities have been rising along with it since February here. All right, so something is going on here that's keeping money moving into utilities. And then the red lines show when the correlation between the 10-year and utilities turns positive to some degree. So, moved up after that, moved up after this one, moved up after here, moved up. Here it moved down. The utilities moved down after a positive correlation, but here they moved up and here they moved up. So I suggest that, maybe that positive correlation is more bullish for utilities. There's a little more evidence that when you're seeing strength, when you shouldn't be seeing strength, that is a sign of even more strength possibly, because when something should be negatively affected by the rising 10-year and it's not, then that tells you there's a lot of buying interest behind it. So that's what might be happening with utilities. Now, when we're in a bear market environment for the stock market, we have to look elsewhere if we don't want to be in cash. Sometimes cash is the best alternative when stocks are in bear market mode. And if we look here at gold, we can see gold has gone nowhere for 2 years. But you could make the case that there's some big trading range going on for 3 years almost. And, we held above this low here, and we had this consolidation, and we had this breakout. So there's a bullish breakout. And I'm sure if you get a 30-minute or 60-minute chart, you're going to see an advance and some sort of a flag possibly. So watch for another breakout there in gold. But, as far as what is holding up in October and acting well, gold would be one thing. And I got the PPO down here, but, it's no help in a trading range because moving average crossovers just whipsaw when there is a trading range. Now, one other item that is showing strength would be palladium. All right, I have no idea why. Because if you look at the autos, they're very weak, and that seems to be the biggest demand for palladium. Maybe there's a demand I don't know about. Could very well be. But if you look at palladium, you had this correction, and then it broke out, and it's continuing to hold the breakout, and it is positive in October. So it is bucking the selling pressure that we're seeing in the stock market and in some other commodities. So if you have any questions or comments or feedback, please send an email to askarthur@stockcharts.com. I can't answer every one, but I promise to answer as many as I can. And sometimes I will feature these questions during the On Trend show. Now we're going to take a walk around the world and look at some global stock indexes as well as some ETFs and show you the currency effect on ETFs. So we're going to start off in Asia and look at the Shanghai Composite, and it was one of the first to break down at the beginning of the year, and it just continued lower, down over 30%. You've had a bounce back this week, but so far it's just a dead cat bounce, clearly within a bigger downtrend. Now we look at India, and India is one of the stronger international markets. Now keep in mind, I'm looking at the country index in the local currency. After this, I'm going to look at the Indian ETF with the rupee and show you this chart. That chart looks a lot different. But if you look at just the India, the Bombay Stock Exchange Index, it's in an uptrend, and it's possibly firming with a higher low. So watch for a breakout at 36,000 to turn this one bullish again. Next is the Nikkei, which is also one of the stronger indexes out there, world indexes. You can see that new high, and it's pulled back, but it's above the summer lows, and that's kind of a benchmark low. If you're below those lows, you're showing relative weakness. If you're holding above, you're showing relative strength. And then you can see the 10-week has been above the 40-week EMA for almost 2 years here. So the Nikkei continues to perform well. But again, we're going to look at the Japanese ETF at the end of this and show you how the currency comes into play. When we look at Europe, nothing good happening here. This is the Euro Stocks index, and you can see it was advancing, and then it peaked there in the middle part of 2017, and its lower lows and lower highs since then. So it continues to work its way lower. Europe has been declining for over a year as a whole. Now, France was holding up within Europe, but we can see that we have a breakdown here with that sharp decline 3 weeks ago actually. We're still above these lows here, but I think this is a breakdown, and you can see the PPO 1040 is at its lowest level since 2016. So the 10-week EMA is the furthest below its 40-week EMA in over 2 years. We look at the DAX. I've showed this pattern before. We have a head and shoulders reversal, and we've broken support here. Now, the alternative would be that this is a big falling wedge. But right now, the head and shoulders is a dominant pattern. The support break is dominant. You know, unless we move back above that support break, the bulls do not have a leg to stand on. And you can see the PPO is at its most negative since 2016 there. Here is the Dow Jones Italy Stock Index, and you can see that it broke support here, consolidated, broke down again, bounced, and broke down. And its PPO is below 5%, so that means the 10-week EMA is more than 10% below the 40-week EMA. So Italy is one of the weakest groups in Europe. Spain, also one of the weaker countries in Europe. You know, it looked like there was a wedge breakout there at the beginning of 2018, but then everything got hit and it totally failed and broke support. And then we continued lower here. And you can see that PPO has been negative since February there. So Spain is one of the weaker groups out there. The UK, I have no idea. We've got this big broadening formation, a lot of uncertainty with Brexit, got higher highs and lower lows. So it looks like we're coming down into this 300, 305 area for the British index. And the Bovespa is one of the stronger indexes out there. All right, we can see that it moved back above its 40-week moving average, and the PPO moved back into positive territory. So it's challenging these highs while the other ones are breaking down. All right, now I want to talk about an ETF and the currency effect. So we've got the Japan iShares EWJ, and below you can see I've got the Nikkei in the bottom window and the Japanese yen relative to the dollar, yen dollar. And you can see while the Nikkei has been moving up during this period from February to September, October, you can see that the Japan ETF has been moving lower. And the reason that is because the yen has been moving lower. And also because the rise in the Japanese stock market is not strong enough to offset that decline in the yen, even though it doesn't seem to be that drastic. And so that's something you have to consider when you're looking at ETFs. So we can see the same situation when we're looking at the India ETF, INDA. All right, instead of making a new high here in the summer, we have a lower high and a breakdown. So this chart looks much weaker, the ETF relative to the index. We can see the index here with the black line, and then it turned down a little bit. But we can see the rupee peaked here in January and has been moving lower. So weakness in the Indian rupee is weighing on the India ETF. So that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.